Hello, and welcome to Investment Insight, your clear take on the markets. Let's get started.
Hey, it's great to be here.
I want to take you back to a specific moment I had just this morning. I was sitting at the kitchen table, drinking my coffee, and I pull up the pre-order page for one of the new flagship smartphones coming out this month,
Yeah.
here in February 2026. And I have to tell you, I physically recoiled at the screen.
Was it that bad?
It was startling. The price tag was it was aggressive. I looked at it and thought, surely this includes a small car or a weekend vacation.
Right.
But no, just the phone. And it feels like we're living in this really weird economic split screen right now.
How do you mean?
Well, on one side, my phone bill, the cost of gadgets, it's all climbing. But then I open up the recent market analysis and I see that the companies actually making the chips for these phones.
The foundries.
Right, the foundries, they are apparently struggling to turn a profit. And then on the completely other side of the spectrum, we have big tech companies borrowing money on terms that frankly sound like a science fiction novel. It just feels, disjointed.
It is a very strange moment in the economy. You hit on something really important there. You have this massive boom in artificial intelligence, which the headlines have been telling us for years means basically unlimited money for everyone involved.
That's the narrative, right? Buy AI, get rich.
Exactly. But when you peel back the layers and look at the actual data, the reality is much more complicated. It's almost a tale of two economies.
So our mission for this deep dive is to connect those dots for you. We need to explain why the AI boom is actually squeezing the life out of the affordable smartphone market.
Yeah.
And then we're going to pivot to the financial side. Why investors are running for the hills, or rather running to the safety of bonds, and how companies like Google are using that fear to secure their dominance for the next 100 years.
And I do mean a literal 100 years.
We are definitely going to get to that century-long loan in a bit because I still can't quite wrap my head around it. But let's start with the thing in everyone's pocket right now, the smartphone.
Let's do it.
So the logic seems simple enough. AI is the biggest thing since the internet. AI runs on chips. Therefore, if you own a factory that makes chips, you should be having the time of your life right now.
You'd think so.
You should be buying yachts and lighting cigars with $100 bills.
That is the intuitive assumption. If there's a gold rush, sell shovels.
Yeah,
Right.
exactly.
But according to recent analysis, looking at data from places like IDC and Reuters, the reality for a company like SMIC, which is the biggest foundry in China, is the exact opposite.
Wow.
Yeah, they're suffering from this fascinating and frankly painful economic condition.
What do the analysts call it?
Profitless prosperity.
Profitless prosperity. Man, it sounds exhausting, like running a marathon but realizing you're still at the starting line.
That is actually a great analogy for their factory floors right now. Let's look at the numbers. SMIC's factories are incredibly busy. Their utilization rate is sitting at roughly 95.7%.
Okay, let's pause there. For those of us who don't speak manufacturing manager, utilization rate just means how much of the factory is actually working, right?
Exactly. Think of it like a hotel. If you have 100 rooms and 96 of them are booked every single night, you're running at 96% utilization.
And usually if a hotel is 96% full, they raise the room rates.
Precisely. In a normal world, if your factory is that full, you have tremendous pricing power. You can tell your customers, hey, if you want your chips, pay up. Or I'll sell the capacity to someone else.
Right. Supply and demand 101.
But that isn't happening here. Being busy is not the same as being rich. To understand why, we have to look at the end product, which is the smartphone. The data for 2026 is predicting a 13% drop in global smartphone shipments.
That's a huge number. So people are just buying fewer phones overall.
Fewer phones. The market is shrinking in terms of raw volume. But, and here's the twist, the average selling price, or ASP, is jumping by 14%.
Okay, wait. Let me see if I can map this out. Fewer people are buying phones, but the phones that are being sold are getting much, much more expensive. Why? Is it just corporate greed?
It's not just greed, no. It all comes back to AI. The specific components needed to run these new on-device AI models, specifically the high-end memory chips, the DRAM, are skyrocketing in price.
Because everyone wants them.
Because the demand from massive data centers is just sucking up all the supply memory.
Okay, this is getting a bit technical. DRAM supply constraints is usually where my eyes glaze over. Let's bring this down to the kitchen table. I think I have an analogy for this.
Hear it.
Imagine a sandwich shop. This shop represents a smartphone maker, like a Samsung or a Xiaomi. Now, to sell a 2026 level sandwich, the customers demand premium steak. In our world, the stake is that high-end memory chip needed for the AI features.
I follow. The stake is the AI capability. You basically can't sell a high-end sandwich without it this year.
Right. But suddenly, every fancy hotel in town, those are the hyperscale data centers, your Googles and Microsofts, they decide they need all the steak for their massive banquets. They buy it all up.
And the price of steak goes through the roof.
Exactly. So the sandwich shop owner is in trouble. His main ingredient cost just doubled.
Yep.
But he knows his customers, regular folks like you and me, we can't afford a $50 sandwich. There is a hard limit to what we will pay for lunch. He can't raise the price of the sandwich enough to cover the new cost of the steak. So what does he do?
He looks for savings elsewhere.
Right. He looks at the guy who sells him the bread.
And in this analogy, the bread baker is the foundry, the one making the non-memory parts of the phone.
Exactly. The baker is the foundry, like SMIC. They make the logic chips, the controllers, the bread, and the cheese. The sandwich shop owner goes to the baker and says, look, I'm getting absolutely killed on steak prices. If you don't sell me the bread for half price, I'm going out of business.
And if the shop goes out of business, nobody buys the bread.
Precisely.
That is a perfect way to visualize it. The smartphone makers are getting squeezed by memory costs, so they are turning around and squeezing the foundries like SMIC, demanding massive price cuts just to keep the final phone price somewhat realistic for consumers.
And SMIC just has to say yes, even though their factory is full.
They really don't have much choice. They need the volume to keep the machines running. And this hits SMIC at the worst possible time. Remember I mentioned they are busy.
Yeah, the 96% utilization, the hotel is full.
Well, the reason they have that capacity available is that they spent billions building new factories over the last 3 years. According to their financial reports, their depreciation costs, which is basically the rent they pay on their own equipment, went up 30%.
Ouch. So their internal costs are up 30% because they expanded, but their customers are demanding they lower their prices because their costs are up.
Precisely. That is the very definition of profitless prosperity. You are working harder than ever, your factory's running hot, but your profit margins are getting crushed from both sides.
And this explains why the budget phone market feels like it's dying.
It is dying. The economics of the cheap sandwich have just broken down entirely. If you can't make a profit on the low-end volume because your baseline component costs are too high, you simply stop making the low-end stuff.
You focus only on the premium gourmet sandwiches where you can hide that extra cost.
Exactly. Which is why when you walk into a store now, the budget option is suddenly $600 or $700. And the recent analysis on SMIC shows they're trying to pivot to survive this dynamic.
What are they doing?
They are actively shifting focus away from cheap consumer electronics and moving toward domestic Chinese AI chips, like the ones used in Huawei's devices, like the Kirin 9030.
Right, I saw the note about the Kirin chip in the data.
Yes. And it's important to view this neutrally. We often look at these chip developments purely through a political lens, U.S. versus China.
Sure, it's always framed as a tech war.
But in this case, it's primarily a survival move. They are trying to move from selling cheap bread to baking their own gourmet pastries chips that have higher profit margins, because the volume business of cheap phones has become an economic trap.
It's really interesting to think about it that way. It's not just a geopolitical chess move. It's a CFO looking at a spreadsheet and saying, we are losing money on every cheap chip we make. We have to change course.
Correct. But speaking of CFOs and spreadsheets, that brings us to the broader macro picture. We've looked at the micro level, the struggling chip factory. Now we need to look at where the big money is flowing globally in February 2026.
And the vibe out there is, well, honestly, it feels nervous.
Nervous is putting it mildly. The data shows we are seeing a classic flight to safety.
Let's unpack that term, because usually when I hear tech boom or AI revolution, I think investors are feeling risky. They're buying startups, they're betting big on the next unicorn, but you're saying they're scared.
They are definitely scared. If you look at the bond market, specifically the U.S. 10-year Treasury, yields have dropped below 4%.
Okay, let's pause. For the listener who doesn't watch financial news all day, help us out with the relationship between yield and price.
Sure, it can be a bit counterintuitive. Think of it like a seesaw. When people desperately want to buy bonds, the price of the bond goes up. When the price goes up, the yield, which is the interest rate it pays out, goes down.
So when you see yields dropping like a stone, it means everyone is rushing in to buy bonds.
Exactly.
And why do people rush to buy government bonds?
Because they are the ultimate storm bunker. When investors are scared of the economic future, they don't buy sports cars, which represent risky stocks. They buy the bunker. They buy U.S. Treasuries.
So the market is effectively screaming that there is a storm coming. What are the specific clouds they are seeing right now?
It's a mix of things here in early 2026. First, you have the political landscape.
Hmm.
President Trump is back in the White House, and there is a lot of policy uncertainty regarding international tariffs.
And investors hate uncertainty.
They loathe it. They don't know how new trade rules will affect global corporate profits next week, let alone next year, so they pull back.
Right. If you don't know the rules of the game, you don't want to place a bet.
Exactly. Then you have the geopolitical tensions mentioned in the recent reports, specifically the rising friction between the U.S. and Iran. That kind of instability always spooks the markets.
Geopolitics is always the wild card. And to be clear, we're just reporting on how the market is reacting to these headlines, not taking a stance on the policies themselves.
Right, we just follow the money.
Yeah.
But there's a third fear, which connects right back to our first topic. The fear that AI might actually disrupt the broader economy too fast.
Like job losses.
Yes. There are genuine worries about jobs and, by extension, consumer spending power. If AI replaces a significant number of workers, who exactly is going to buy these expensive new phones? So you have this cocktail of tariff anxiety, geopolitical anxiety, and tech disruption anxiety.
So everyone just piles into the bunker, they buy bonds.
Yes. But here is where it gets really interesting. This flight to safety isn't treating all companies equally. It's creating a massive split in the corporate world. We're seeing a K-shaped reality for businesses.
The rich get richer and the poor get squeezed.
Exactly. In finance, we look at investment grade versus junk debt. Because everyone wants safety right now, investors are pouring massive amounts of money into the debt of huge, safe, profitable companies.
So if you are a giant corporation with a AAA rating, life is fantastic.
It's incredible. You can borrow money incredibly cheaply because everyone is desperate to lend to you. They trust you won't go under.
But if you're a small company, a risky startup,
You are left completely out in the cold. The spread, which is the difference in the cost to borrow between a safe company and a risky one, is widening dramatically.
Right.
The market is effectively saying, we will trust the giants with our money, but we won't touch the little guys.
Which brings us to the biggest giant of them all. This is the part of the research that literally made me stop and reread the sentence 3 times.
The century bond.
Yes. Alphabet, Google's parent company, issued a bond that doesn't mature for 100 years.
That's right.
I just want to sit with that for a second. 100-year loan. That means they are borrowing money today in 2026 that they do not have to fully pay back until the year 2126.
It is staggering to think about.
Why? Why would they do that? And maybe more importantly, who on earth is lending the money for that long? I don't even buy green bananas because I don't know what the future holds, so who is buying a 100-year IOU?
It connects directly to that flight to safety we just discussed. Because investors are so desperate for safe places to park their cash, big tech companies are in this totally unique position. They could look at the market and say, hey, we are as safe as a government, maybe even safer. Lend to us.
And investors desperate for a safe yield just say yes.
They line up for it.
So Google is taking advantage of the market's fear to lock in cheap money for a century, but what do they actually need all that money for? They're a software company, right? They write code. Code is cheap.
That is the old way of thinking. And this might be the biggest shift in the economy right now. We need to completely update our mental model of what a tech company actually is.
Okay, updated how?
Well, they used to be asset light. A few geniuses, some beanbags, laptops, and a rented server room.
Right, the whole Silicon Valley garage myth.
Exactly. But now, they're becoming extremely infrastructure heavy. They're turning into massive industrial giants.
Infrastructure, you mean like roads and bridges?
Like massive power plants and acres of data centers. The amount of money needed to build the physical backbone for AI is astronomical. The recent data estimates that hyperscaler spending, that's your Amazons, Googles, Microsofts, could hit $770 billion in 2026 alone.
$770 billion. And just for context for you listening, that is bigger than the entire GDP of Switzerland. That is an insane amount of concrete and copper and silicon.
It truly is. They are building the physical structures that will power the next century of computing intelligence. They need to buy the real estate, build the advanced liquid cooling systems, secure dedicated energy grids.
They're effectively becoming utility companies.
Exactly. And what do traditional utility companies do? They take on massive long-term debt because their physical assets last a very long time.
So they are taking out a 100-year mortgage on the future of AI.
That is a brilliant way to put it, but there is a massive catch.
There's always a catch in economics.
The risk. Think about it. When you take out a 30-year mortgage on a house, you assume the house will still be there and still be valuable in 30 years. Houses are stable technology.
Unless you have a really bad termite problem.
Right. But Alphabet is betting that this specific AI infrastructure, these data centers they are pouring concrete for today, will generate returns for a full century.
But tech changes so fast. I mean, look at a desktop computer from 20 years ago. It's a doorstop today.
Exactly. That is the massive inherent risk. What if AI turns out to be a financial bubble? Or, perhaps more likely, what if the underlying technology changes so rapidly that these massive data centers become completely obsolete in 15 years?
Right. If they invest $700 billion in Generation 1 AI factories, and then Generation 2 requires a completely different physics model or a new energy source.
Then they are stuck with a 100-year debt burden for a totally useless asset.
Wow. That changes the risk profile of these companies entirely. They aren't just nimble tech startups anymore. They are heavy, debt-laden industrial giants.
It's a profound structural shift. We still like to think of them as these cool, agile innovators in hoodies. But financially speaking, they're starting to look a lot like the railroad tycoons of the 1800s.
Oh, like the robber barons.
In a structural sense, yes. The railroads built massive iron and steel tracks across the whole country, and it was fueled by massive long-term debt. It completely changed the world, but it also created monopolies and huge, devastating financial bubbles.
And big tech is doing the exact same thing today, but instead of steel rails, it's fiber optic cables and GPUs.
Exactly.
And just like the railroads, they are reshaping the entire landscape for everyone else in the process.
Correct.
So let's bring this all down to the ground level. We've talked about Chinese foundries, we did a sandwich analogy, and we looked at 100-year bonds. What does all this mean for the person listening to this right now while they drive to work?
I think there are two main impacts to take away. First, as a consumer. We touched on this with the sandwich shop. The era of cheap, high-quality electronics might be taking a pause.
Because of that chip squeeze we started with.
Right. If the low-end market simply isn't profitable for the manufacturers because of the AI tax on memory chips, companies will just stop making those entry-level devices.
So you might go to the store to buy a budget phone for your kid or an affordable laptop for school and find that the options just aren't there anymore.
You're forced up the ladder to the expensive stuff.
So my wallet is definitely going to feel the pinch. The middle class of gadgets is basically disappearing.
Very likely, yes. The second big impact is on how you view the broader economy and your own investments. We are seeing a real layering of the economy.
How so?
Well, if you work for or invest in the safe giants, the big tech terms, the investment-grade companies, things look incredibly stable, even booming.
But outside of that fortress.
If you were in the risky layer, small businesses, startups, speculative tech ventures credit is getting tighter, and mere survival is getting harder. The giants are sucking up all the available capital and all the physical resources.
It really is a split-screen economy.
Exactly. And for the average investor, looking at your 401k, it explains why that safety trade bonds is back in style. It's not just an investment for retirees anymore.
Right.
In a world where the future feels incredibly volatile, with tariff debates, geopolitical tension, and massive AI disruption, that storm bunker looks very attractive to a lot of people.
You know, this whole conversation raises a really big, almost philosophical question for me. We are seeing private companies issuing bonds that last longer than most governments stay in power. They are building the physical infrastructure of the world, funded by debt that is going to outlive all of us.
It really challenges our traditional view of where global power actually lies.
It does. So here's the thought I want to leave you, our listeners, with today. If private tech companies are borrowing on 100-year timelines that are usually strictly reserved for sovereign nations, who is really running the long-term strategy of our economy? Is it the elected officials in Washington focused on the next 4-year election cycle? Or is it the CEOs out in Silicon Valley financing a concrete vision for the next century?
That is the billion-dollar or perhaps the trillion-dollar question right now. When a company plans for the year 2126 and a government plans for 2028, the company has a massive strategic advantage.
It certainly does. So to quickly recap what we covered today, the AI boom is making your phone's internal ingredients much more expensive, which is squeezing factories like SMIC into a state of profitless prosperity. Meanwhile, widespread fear in the market is driving interest rates down, which allows big tech to lock in 100-year loans to build their massive new empires, effectively leaving the smaller players out in the cold.
A fascinating, if slightly unsettling picture of our economy in 2026.
Absolutely. Well, that's all we have time for today. Don't forget to subscribe and hit that like button.
Goodbye, everyone.